say this is a non-event. You can declaratively say that.
Well, I think most news headlines tend to be non-events for the marketplace. And there's a lot of attention people put on these headlines, and the wrong thing to have done over the last few years was to actually turn on your TV. Stock markets have done okay. They've been volatile, but they've done fine.
So if you traded on the back of headlines, you'd be
probably best to focus on the fundamentals
position
of your companies that you invest in, which is what we do at First Eagle. We're bottom-up investors. We don't spend a lot of time on whether it's sequestration or debt, negotiations in the White House, et cetera.
Okay.
Well, speaking of fundamentals, there does seem to be this tide shift happening in Japan. People are now actually calling it Abenomics. I love that. Obviously, what they're talking about is Shinzo Abe's push to perhaps stop deflation.
Yeah.
How do investors refocus their portfolios on that? I mean, there was this notion always that local companies in Japan were very cheap. Are you going to change your view on that?
I think the local companies still are pretty cheap. We own a lot of companies that still trade close to the net cash value on the balance sheet. Some companies that trade at 1 and 2 times earnings. There are the export-led companies that have actually done quite well on the back of the depreciation in the yen. I think the more significant event maybe later this year is the reemergence of inflation in Japan for the first time in quite some time.
So you think they're exiting deflation?
I do believe that is around the corner for them, yeah.
Okay.
Now, talking about inflation, your number one holding right now is gold bullion. And Ben and I were just talking about, is the gold bull run over? And I want to put up this pretty striking chart. We had a massive outflow of the ETFs, about 110 tons just in the past few weeks. Do you think there is some kind of sea change here when investing in gold?
Sentiment follows price in the market, and gold stocks and gold bullion have been down for this is the 3rd straight year. And not surprisingly, there has been some frustration, while at the same time the stock market has actually done pretty well. So in the face of all these global economic challenges, whether in Europe, Japan, China, the United States, stocks have done pretty well, gold has not done well. So there's naturally a reaction against that. I think it's totally normal to see that kind of in and out in a market. But in the end, the problems we have structurally are still there. I think it's a good thing to have some of your portfolio in gold. And the fact is gold stocks now, after underperforming for 3 years, are quite cheap.
So, but you have gold bullion.
Yes, also.
Also. But isn't that a majority of your gold holdings, though?
It's about half and half.
About half and half.
Yeah.
Okay. You also have a lot of cash, though, right? 20%?
Yeah.
Why?
Yeah. Well, related to the fact that stock markets have gone up a lot, we're value investors at First Eagle. And the tendency is for us to become more cautious as prices get closer to fair value. So it's a reflection that, the marketplace generally prices in, a sort of sense of normalcy in the market. So thus the cash holdings.
So you're, okay.
What would the catalyst be to actually put that cash to work? Are you just waiting for a leg down in stocks?
Whether it's an individually legs down in stocks or, a market event, we're not going to prejudge the outcome. But clearly, if stock prices got to closer to big discounts to intrinsic value, then we'd be more interested in deploying that cash.
Well, if you were to put some of that cash to work, would it be back into the equity markets, or are you looking elsewhere?
We're flexible. We're like a really cheap hedge fund. We can do everything within the First Eagle Global Fund, and wherever those opportunities surface, we're going to try to take advantage of those.